morning, which is looking at income, and in particular high income, higher yielding trusts, titled a little bit extra, which may be what investors are looking for. Many investors obviously seek to drive an income from their savings, and one of the key benefits of investment companies is both their ability to pay yield, obviously, but also their ability to smooth income over time and to manage that income out for the end investor, so that they can be there as an income-paying part of an investor's portfolio. I'm very lucky to be joined this morning by three managers from the sector. Immediately on my right, David Moss from the CT UK High Income Trust, Roger Coyle from Fair Oaks Income, and Andrew Hampson from Tufton Oceanic Assets. And I'm just going to start, gentlemen, by asking you just to give the audience a brief introduction, if I may.
Thank you very much. Good morning, everyone. So my name is David Moss, as you heard. I run the CT UK High Income Trust. CT is Columbia Threadneedle Investments, and it is a pretty standard UK high income equity trust.
Roger.
My name's Roger Coyle. I'm a partner at Fair Oaks Capital. We're a London headquartered corporate credit specialist investment manager. We manage about 3 billion in total across a range of funds, limited partnerships, UCITS funds, and investment trust called Fair Oaks Income.
Andrew?
Hi, I'm Andrew Hampson. I'm CEO at Tufton Investment Management. We're a specialist fund manager in the maritime space, and we run a number of funds, including Tufton Oceanic Assets Limited, which is listed on the London Exchange in the specialist funds segment.
And you all obviously seek to offer investors a high income. I think at the moment, between the three of you, yielding somewhere between sort of 6.5% and as much as 14%. Perhaps let's come back the other way, Andrew, starting with you. Just outline a little bit the strategy you use within your fund, both in terms of the types of assets you invest in, but how you go about delivering that yield for investors.
Sure. Thanks, Richard. It's very simple, really. We buy and operate deep sea cargo carrying vessels. Within Tufton Oceanic Assets at the moment, we have 20 ships. The majority of them are on medium-term charters to recognize names. We generate an operating income from those vessels, which is approximately twice the level of the dividend payout, which is currently just under an 8% yield. The remainder of the excess cash flow goes towards capital expenditure for maintaining the existing fleet, and also reinvestment into newer tonnage, so that we try and keep the average age of the overall fleet roughly the same. So we use the excess cash to offset depreciating assets. Because the majority of the assets are on fixed charters, we know the income amounts. The operating costs of shipping are very well known, and therefore we can make good and fair predictions as to our future levels of cash flow, and we currently have a dividend cover level of about 1.7 times over the next 18 months.
Roger.
So Fair Oaks Income Limited has a dividend yield of about 14%. I won't say it's simple, but so we invest in corporate loans, but we do so through CLOs, collateralized loan obligations. And they're securitizations. So they're vehicles that hold diversified portfolios of senior secured loans, and then that's financed with rated notes, about 90% rated notes, and about 10% unrated notes, which we call CLO equity. And essentially how it works is the CLO invests in loans that pay base rate plus 3.5% to 4%, and then it's 90% financed with CLO debt, which pays base rate plus like 1.75% currently. So that then generates a mid-teens yield on the CLO equity. And we like CLOs for a couple of reasons. One, we can generate that mid-teens return on corporate loans without stretching into stressed debt or senior unsecured high-yield bonds or smaller unrated companies. We only lend to large corporations. And the other reason we like them is the leverage, essentially, that's embedded within the CLOs is it's long-term financing, so kind of match maturity financing, and unusually no mark-to-market triggers. So we can just focus on the performance of the underlying loan portfolio.
Very good, thank you. David?
Well, mine certainly is very simple, certainly of these two gentlemen here. So CT UK High Income Trust is a portfolio of predominantly UK equities, 38 names in the portfolio at the moment, and we look to use that portfolio to drive a appropriate yield for our shareholders, and the aim is that delivers a high level of income now, and that income grow in the future. So every stock we own, we look not just for high levels of income, but growing levels of income. Therefore, our shareholders can own this trust, get income now, and be confident that that income will grow into the future for them as well. But as I said, predominantly UK equities, pretty straightforward.
Nice and simple. Coming back to you, Roger, you said that you only lend to sort of large corporations. I think one thing that investors perhaps get a little bit nervous about sometimes when they're looking for yield is they see higher yielding stocks, investment trusts, and they get nervous about, is that a real, how sustainable is that over time, or is that going to get eaten away? To what extent can I depend on that? Am I in order to get that higher yield, am I having to take higher risk? I guess is the question. So is it possible to get that high yield without higher risk?
I mean, broadly speaking, no. I think, if you're getting a double-digit return, you're very likely taking more risk than if you're getting a 4% return. So, big picture, of course, you take more risk for a higher return. But I think there's 2 points, kind of key points here. One is what risk you're taking. So understanding how much of that is, liquidity risk, how much is credit risk, which, can ultimately impact your long-term return, how much is mark-to-market risk or short-term volatility. And it's hard to, exactly determine how much of each risk you're taking, but I think it's important to understand that and then compare that to your investment objectives in terms of kind of time horizon and sensitivity to short-term volatility. I think the other point is, yes, a 14% return will kind of incur more risk than a 4% return, but there are products where you can earn, 14%, we believe at least, and take less risk than some other products with a 10% return. But you need to understand why that is. Is that because, the product is complex, for example? So some people just don't want to invest or take the time to understand it. Is it misunderstood? CLOs, for example, are confused with CDOs, which are kind of mortgage-backed securitizations that kind of were significantly involved in the financial crisis. So that kind of guilt by association can explain kind of relative value on the kind of risk-return spectrum. And I think also there's just, what's kind of in fashion at the moment and kind of the supply-demand imbalance. So, arguably, when you look at areas like, tech stocks in the equity world or private debt, I think within the credit world, you can argue that there's a kind of an imbalance of demand versus supply. So I think, within a kind of an area on the risk-return spectrum, I think there's kind of pockets of relative value, and you need to understand why you're getting paid more. But yeah, of course, you're taking more risk getting a double-digit return than a single-digit.
And Andrew and David, perhaps in relatively simpler assets, if I can put it like that, in terms of that trade-off between risk and return?
Well, the maritime world is a relatively risky one, and there are many different strategies which one can deploy, although you or the general universe may perceive it as a very specialist area. There are indeed very different segments within it which operate very differently. Container ships operate very differently from oil tankers, which are dependent on energy, to dry bulk carriers, which are dependent upon infrastructure development and agricultural produce, etc. So you're exposed to a lot of different facets of the world economy and world demand, as well as the supply side of the actual ships themselves. So, yes, I mean, if you like, sector picking within our narrow sphere is actually very important to us to work out the correct risk-reward profile. At the moment, majority of the maritime world is in reasonably healthy states, and so spreading a portfolio across the different sectors we think is the best strategy. But yes, if one wanted to take more risk, you could go into a riskier segment quite easily, but we would tend to err away from that.
I mean, in terms of ourselves, I mean, clearly we invest in equities. Equities are at the bottom and the top of the capital structure. So if we leave that aside, actually, I think you don't need to take more risk. There is a perception that a high dividend yield in equity must be higher risk, or there's something wrong with it. I think one of the beauties at the moment of the UK market particularly, and this is talked about at great length by many commentators, is the market is very cheap. And therefore, we're getting to buy some really good businesses with really high dividend yields because the market's not liked, the sector's not liked, it's misunderstood. And therefore, actually, no, I don't think you're taking higher risks for those higher yields.
And it's fair to say that you're trading on discounts, even though you've got those high yields. Does that then provide a sort of double whammy opportunity, if you like, for investors? Is there the potential for some capital growth there as well as that yield going forward?
Well, I think personally, I think there's potential for capital growth anyway. I mean, first of all, we invest in equities. History tells you that equities tend to go up over time. The fact that we're buying equities where we believe the dividend can grow, so all else being equal, the yield stays the same, the capital should go up. And yes, the discount is an added kicker on top of that. So yes, I'd agree with that statement.
I mean, discounts are attractive as long as you believe they're temporary. Buying something at a 15% discount is great unless you might have to sell it at a 20% discount. And over time, obviously, the discounts are problematic because if companies can't issue shares because they're trading at a discount to NAV, they can kind of shrink and ultimately become unviable. So we've done a lot. I mean, since we launched the fund 10 years ago, we put a lot in place to avoid trading at a discount. We have there are different reasons funds can trade discounts. So, do people kind of trust the NAV? Are the fees too high? So, we had kind of robust NAV processes, good transparency. We had share buybacks, reinvestment of management fees if the shares were trading at a discount. Periodically gave investors a chance to switch into a realization share class to give kind of maturities every so often. So we put a lot in place to avoid it. But in 2022, our shares started trading at a discount, which reached 17% at one point. And what happened kind of across the investment trust universe, and they've been discussed here already, is some cost disclosure rules changed for institutional investors, and that just made holding investment trusts less attractive. Our investor base, like many investment trust investor bases, was relatively concentrated. So we had a share overhang, which is another kind of reason for a discount. So we worked a lot in 2022, 2023 to kind of diversify and refresh the investor base. So now actually the shares have been trading close to NAV this year. They're at a 2% discount at the moment, I think. So yeah, discounts are a good opportunity if they're temporary.
Andrew? We started the year trading at about a 30-35% discount. We announced publicly what we called a midterm strategy review, which looked to try and put a date on the realization of the fund, and we put that between 28 and 2030. Since the beginning of the year and the strategies that we announced earlier on, we've had a total share price return this year of 38% in terms of dividend and share price appreciation, and we've closed that discount now to around about 13%. The NAV, we have very high conviction on our NAV. Shipping assets, believe it or not, are traded in the second-hand market. In a very, very active market. It's about $45 billion worth of second-hand ships traded each year. So it's very easy to get a mark to market on what is quite a complex asset itself. Of all the ships we've sold over the last 7 years, the aggregate sales price has been 6% above the published NAV. So in our mind, SHIP, sorry, its ticker I refer to it as SHIP. By the way, that was a ticker that cost me £3.45 on my Visa card to actually buy, which maybe actually shows how common maritime stocks are on the London Exchange. But it also, by the way, goes by a ticker of SHPP, which is a sterling class. The SHIP is a dollar class stock. So we have very high conviction in the NAV, and we firmly believe that that is the right price. So, I mean, if the question is there added appreciation there, the answer is definitely so. And announcing that strategy review with an exit strategy in 4 or 5 years' time, I think has focused investors on looking at that exit and realizing that NAV as we go forward.
Very good, thank you. David, you talked about income growth and trying to deliver not just a high yield, but potentially a growing dividend over time. The turn in the interest rate cycle, for those of us still servicing a mortgage, hopefully interest rates are now going down rather than up any further. Does that impact your ability to deliver that, or to continue to deliver yield and potentially grow that?
I mean, it has no impact when we look at the stocks that we own in the portfolio on the ability to deliver income. One would hope it would make that level of income more attractive. Yep. So we pay a high dividend yield at the moment, it's sort of around about 6.25%. That was great when yields were zero. We can get 5% in your bank account. Maybe investors have a more difficult choice. Yep. So if you're getting a lower yield on interest, that makes it more attractive. One would hope, and we believe, that the turn interest rate cycle should be positive for UK equities. I think, as we all know, sentiment in the UK is dominated by house prices. That's been a bit difficult. The mortgage market's been very weak, so a turn in that cycle should help that. And therefore, we believe it should help is the prospect for capital growth. Income can still grow as it would have done historically, we believe.
Very good. Andrew, do you want to?
Interest rates and shipping freight rates are not correlated at all. So in the same way, if you like, our total yield from the portfolio doesn't change when interest rates go up, and therefore the stock becomes less attractive when risk-free moves from 0 to 5. And I think in the same way we maybe all suffered from part of the discount being part of that making the stock less attractive. However, in the maritime world, if you like, indirectly, interest rates and thereby inflation have a very positive impact on the valuation of assets. Basically, a ship, in essence, is about 70% of the value of a ship is dollar-denominated Asian labor, is steel, and is usually European-based equipment. So all of those factors increase with inflation, so new building prices increase. A higher new building price filters through to higher second-hand prices because your replacement cost is actually increasing. So in an indirect way, higher interest rates and an inflationary environment are actually very good news for our industry. And you can look at this historically, the areas of high inflation, we've had vastly increasing asset pricing. And that, again, drives the NAV up. But the freight rates, the actual earnings, don't actually respond.
And Roger, you're not in that sort of real asset or equities world in terms of the investment assets that you're investing in. So sensitivity in your area to interest rates and potentially that turn in the cycle?
Yes, so there is some. So the CLOs in which we invest, they have floating rate loans, floating rate assets, but they also have floating rate liabilities. And the majority of the return comes from the credit spread and the differential in the credit spread. So, but there is some exposure to floating rate. So yes, like a 14% return can become a 13 or a 12 just through rate decreases. But there's also a positive impact. A big driver, but the biggest driver of returns is the performance of the underlying loan portfolios. And high rates are bad for the corporate default rate. So lower rates actually usually means lower corporate defaults, so lower credit losses in the portfolio, which helps the return. So it kind of has two impacts which offset each other to some extent.
Very good. Now I'm going to open up to the floor for questions in a minute, but just one, before I do that, whilst you think about what you might want to ask, one other area that obviously investment companies have an advantage as a structure because you can gear the fund as well. You have the ability to borrow. I think one of you is using gearing at the moment, but do you want to talk a little bit about how gearing, David, start with you, how gearing is used in your fund and how that impacts the yield that you can deliver?
I mean, I think it's one of the key benefits of the structure. Clearly, you can use it in many ways. You can make market directional calls, which we don't. You can be opportunistic, which we do to some extent. But for us in particular, we obviously pay a high dividend yield, and much higher than the market. So that means that inevitably, in terms of the stocks we own, we're biased towards income generators. So therefore, we can either use that leverage to buy more capital growth type stocks or add to that level of income. Additionally, one of the relatively unique features of high income is that we can have up to about 10% of the fund in European stocks. And at the moment, it's at the lower end of that, primarily because, as I said, the UK market's so attractively valued, why go to Europe? But we do have 3 stocks that are much higher growth. They're exposed to electronics and technology and software. You can't get access to the UK. So we can use that gearing to gain access to greater growth opportunities than perhaps we'd ordinarily see. So I think it drives higher return, can drive higher income, and just gives you more flexibility.
Okay, very good, thank you. Andrew, do you want to?
I've been in the finance and investment side of the maritime world for nearly 45 years now, and I know well the dangers of high leverage in asset class, which is potentially volatile in its earnings and in its values. So in SHIP, we have very, very limited use of leverage, and in fact across the other portfolios that Tufton run, which are mainly private accounts running the same type of strategy. Overall, we have very, very low levels of leverage. I think one of the mantras in shipping, or at least one of my mantras in shipping, is that you have to maintain control of the assets. And one of the easiest ways to lose control of an asset, which is volatile in its value, is to allow the bank to keep you awake at night. Let them creep in. The other one is actually joint ventures, where your joint venture partner can't come up with the money when actually needed. So we own the assets 100%, we control the assets 100%, and we have very limited use of leverage as a consequence.
And Roger?
So Ferrex Income has no leverage at fund level, but there is leverage within the investments. I mean, for us, I guess the 3 risks of leverage are, number one, refinancing risk. If you've got short-term leverage, long-term assets, if the leverage just can't be rolled over. Number 2, margin calls. Most leverage has kind of mark-to-market triggers. You have a margin call, you can be forced to sell assets at the worst time. And then the 3rd risk is really just leverage, obviously, kind of increases the volatility of the shares, because as it'll be a multiple of the volatility of the price and the underlying assets. I think our structure basically eliminates the first 2 risks. It's long-term leverage with no mark-to-market triggers, so the loan portfolios can go up and down in price and there's no impact. But we can't eliminate the 3rd risk. So you'll see volatility in our shares in 2016, 2020, 2022, which is amplified by leverage.
Okay, thank you. Open the floor to questions. I think there was a gentleman, Tamara, in the front row here who had a question.
Question for Andrew, if I may. Is there an overhang or large supply of new shipping on the way, or is it a very tight market?
I'm not sure whether everybody heard that. The question was, is there an overhang of shipping or a new set of shipping on the way, basically?
Is there a supply of new shipping on the way, shipbuilders with a,
Clearly somebody who knows a little bit about the maritime world. The world order book, so i.e. the supply of new ships that is going to come is going to come into play, is relatively high at the moment. It's about 35% below the peak that we saw in 2008, prior to the financial crash. But the problem at the moment, there is a shipyard capacity across the world. Japan and Korea, as main shipbuilders, have been declining quite a lot recently. China has been expanding and roughly matching the decline that we've had in This is in terms of yard capacity. So yard capacity at the moment is full. So if you order a ship today as a new ship, you're not going to get it until 2028. That has the ability of giving us very, very strong visibility on the supply side of the market over the next 4 years. But the answer is, yes, there is a large order book, but yes, it is coming over a long period of time. But equally, if you go back to when China joined WTO in 2002, and there was a massive uplift in world seaborne trade, which 85% of which, by the way, travels by sea. That massive uptick led to a massive new building program of all types of ships from 2004 through to post-financial crash. That age bracket now is coming up to 20 years of age. So there is a very uneven and massive replacement need for that older tonnage now, and the current yard capacity isn't enough to actually do that replacement, let alone substitute for demand growth.
There's a specific question online. I'll come to the audience again in a second. There's a specific question online for Roger. Roger, why is your base currency for your shares quoted in dollars and not in sterling? Which I guess is, given a UK audience, is...
Yes, so we'd like to have a sterling class to be kind of in the index and kind of easier to invest in, but the assets are USD and euro. Historically, our fund was 100% invested in USD assets. Now it's a mix of USD and euro, but yeah, we just matched the assets, and yeah, for most of our investors, they were kind of indifferent.
They're comfortable with that. Thank you. There was a question here, and then I'll come to the back over there. I think it was, yeah, the gentleman there in the... Everybody's being too polite. Go on.
I've got a question for David Moss. David, you inherited a rather complex capital structure from F&C, and I was wondering, would you be... I think there's 3 classes of shares, correct me if I'm wrong. Would you be happy for the board to consolidate it and make your life a bit... Because they're not very marketable, the 3 classes, and it just looks as though it could be simplified.
Thank you for that. We are down to 2 now. So we had A shares, ordinary shares, B shares, and units, which were a mix of Bs and ordinaries, which was incredibly complicated. The units no longer exist, and the underlying unit holders got the relevant shares in the ordinaries and the Bs. I mean, it is a bit complicated. It does dilute the liquidity clearly of each individual class, but the advantage is it helps us, frankly, pay a high yield, and for some investors, maybe one fits the other. So the ordinaries pay the dividend out of income, and the B shares pay out of capital. So that may still fit some investors. I think probably less than it once did once upon a time. It also means that all the income we generate, we can pay out to the ordinary shareholders. So the yield that ordinary shareholders get is much higher than the actual running yield of the portfolio, and then the B shares we pay out of capital. So I think it's quite helpful in many ways. Yes, I get the liquidity question. I wish we had more liquidity. But now we're down to 2. I think that's relatively straightforward. Relatively. Thanks for the question.
There's a question at the back, and then there's another one in the middle. The gentleman... Oh.
Question for Roger. So we've seen a lot of CLO ETF in the news sort of being issued, and what's the impact of that on the equity tranches? And also within Fair Oaks, how active are you guys within the equity tranches in terms of refinancing, resetting and calling? Do you take a more active approach to that, or do you sort of sit back and let it play out?
Yeah, so I guess so I mentioned earlier we manage UCITS funds as well. We actually launched a CLO ETF a few weeks ago. UCITS funds and ETFs work for CLO debt because it's more liquid than CLO equity. They don't work for us for CLO equity. We need a closed-ended fund. So particularly because our kind of strategy on CLO equity is to have the majority of the equity of a particular CLO so that we control the structure. So the investment trust works well because we can give investors some liquidity through daily trading, but for us it's a closed-ended fund, which kind of leads on to the second part of the question in terms of refinancing and resetting. We like to have the control of a CLO because the management of the liabilities is quite important. I said earlier that a CLO invests in loans that pay kind of base rate plus 3.5% to 4%, and the liabilities are long-term locked in base rate plus 1.75%, but we have some optionality. So when CLO liabilities get cheaper, we can refinance those. So you keep the loans at the same rate, but refinance the liabilities. So yeah, so we do a lot. We reset a CLO recently. We refinanced one a couple of months earlier. We're calling one. So yeah, it's not going to get too technical on CLOs on this panel, but yeah, the management of the structure is important.
Come back to the gentleman here, and then there's a question over that seat.
The text for this session talks about getting a little bit extra over a bank account. With a bank account, I can get my money back. So in 10 years' time, can you give me my money back? Can you guarantee it? No. So what is the chance of me getting less than 75% of my money back in 10 years' time from each of you?
Oh, there you go.
Well, maybe I'll start then as on first here. Again, we're investing in equity, so I can't tell you what the equity market will be in 10 years' time. I can tell you, although I don't know the numbers, that pretty much any 10-year period, equities will go up because they're real assets in a world where, apart from maybe a lot of the last 10 years, we have inflation. So I would be highly, I wouldn't say confident, but I highly expect that you'd get more than your principal back in 10 years' time, and you'd have benefited from about 65% of income over that 10-year period as well. So to me, that's a very attractive risk reward.
Can you put a percentage chance of that?
I've got no way to calculate what that percentage is. It would be a guess. I think it's very low.
What's your best guess?
On a 10-year, my best guess is less than 10%.
Yeah. Roger or Andrew, you want to?
I don't think I'll be pinned down to a percentage, but I think, obvious disclaimer is it's not a guaranteed principal. Your principal is at risk in a high return product. We believe, so number one, we pay out less income than the fund receives. So like we paid 8 cents in the last year and the fund received 13 from the investments. So I think as well, our investments, they have a track record. Even CLOs that were kind of issued just before the financial crisis had positive returns. We've invested in CLOs that have had single-digit returns, so they don't all necessarily return, 15, 16, 17%. But we've never invested in a CLO in the last 10 years, and the 98% of CLOs issued even just before the financial crisis did not, made a positive return. So yeah, there's variability of your return, and it's not guaranteed, and I can't put a percentage on it, but even the high income makes it unlikely your return will be negative. Will you get 14% return and then 100% of your capital back after 5 years? Maybe not, but will you earn a decent positive return? Most likely.
Andrew, I'm going to take the next question.
Sure.
From,
It was the same answer.
To me, yeah.
Yes.
Another question for Roger. I think you've probably answered this, but I'm assuming most of your underlying loans are to US companies. If you could just confirm that. Secondly, what is the average public rating on the portfolio? And thirdly, what are the typical terms of these CLOs that you're investing in?
Yes, so I guess quickly on that. So our portfolio was 100% exposed to US loans. Now it's a mix. It's like 65-35 roughly US and European, euro-denominated loans. I forgot what the second question, part of the question was.
Rating?
Oh, rating, yep. So they are sub-investment grade loans, so rated single B or double B. CLOs typically can't buy triple Cs, although some loans can get downgraded to triple C. So you'll have a few % of triple C in there. but they are sub-investment grade loans. The terms of the CLO, I mean, they're quite complex, very structured documents because some of the notes they issue are AAA rated, so they're very kind of tightly controlled. They tend to have like a 13-year maturity, just so you know the financing is there for that long, but their typical life will be kind of 5-6 years.
Excellent. Thank you. Now, a question for all of you that's come in online, but I'm going to start with Andrew on this one. Given the conflict in the Middle East, what impact do you expect on interest rates and oil prices, and how will that impact your strategies, specifically risks to freight for the Maritime Fund as fuel cost rises, and for the CLO Fund as a second wave of rate hikes might come in?
No, that's a great question, actually. I'm pleased somebody's asked that. I mean, I think pretty well publicised since the conflict in the Middle East has actually started. The Red Sea has, in effect, been closed to shipping, and Suez Canal has been closed. If you're a provider of tonnage to the market, which is what we do, it's very, very positive news. You need more ships to continue the same trades that you needed before, because each ship has to actually go further. Unfortunately, within shipping, most adverse geopolitical events are actually good news for shipping. The world's, the maritime world and the world trade routes work on the most efficient and the most economic model possible. When you have any disruption, be it a closure of a canal, an area to avoid, trade tariffs, environmental issues in the Panama Canal, etc., it means you need to go further, and therefore you need more ships. So as a tonnage provider, it drives up the asset pricing because there's a shortage of supply of ships. Freight and fuel prices doesn't bother us, and there will be higher fuel prices because it's the charterer and not the owner who, not the asset owner, who pays the fuel bill. So it's actually good news for us, but in an adverse situation, of course. But it's good news for the asset class.
Now, we've got a couple of minutes left, so we answered this kind of inflation or interest rate question earlier, so I'm going to finish with a question to each of you in turn. Just quickly, what's the thing that you're most optimistic about within your portfolios at the moment? End on a positive note. David?
I mean, we'll see what happens on October 30th, clearly, but I'm pretty optimistic on the UK economy. We have increased our exposure to the domestic UK business. Clearly, it's been in the doldrums for quite some time. I think we can look forward to with greater confidence, and therefore that's a big positive. Again, let's wait and see October 30th first before I get too confident.
Roger?
I think lower rates really helps kind of corporate credit investments. We've had an increase in defaults, over the last couple of years because of COVID, because of inflation, because of higher rates. But now we're kind of through the worst of that, and touch wood. And the increase in defaults has been kind of a lot less than expected and kind of within model parameters. So I think we're in a kind of macroeconomically in a better position now.
The maritime world is dependent on the world economy, and however great we feel Great Britain is, actually it has very minimal impacts on world seaborne trade. So it's really more global events, that we look to try and work out the macro picture. Clearly, results of U.S. election are a fairly major thing. I think we're fair to say there is one party there who may start to look at trade tariffs, etc. That has a big impact. The geopolitical events that you've mentioned again have a big impact. But I think from a positive side, and back to the question that we had earlier on, it's a supply side squeeze that we think will actually benefit the maritime markets over the next 5 years. The demand will be variable because of all of these various geopolitical factors. But from the supply side, the world needs more ships, and you're not going to stop seaborne trade. As I say, 85% of world trade travels by sea. There isn't a substitute. Air is a nonsense when it comes to trying to substitute shipping, particularly in an increasing green environment due to the emissions, etc. So maritime is the only way to transport stuff around, and there are not going to be enough ships to do it.
Excellent. So 3 positive notes there to finish on. Thank you very much for all your questions. That brings this panel to an end. So thank you to David, Roger, and Andrew.
Thank you.